The GST margin scheme and going concern exemption are aimed at reducing the amount of GST payable. Kelly is a small property developer who is registered for GST. One of Kelly's developments consisted of buying an established house in 2020 for $660,000, which she demolished. She then built 3 townhouses on the land at a cost of $770,000. Kelly then sold these 3 townhouses together for $1.87 million. When Kelly sells the townhouses, as they are new housing, they are subject to GST. However, her purchase of an established house does not entitle her to input tax credits, because established residential houses are usually input taxed. For Kelly, participation in the real property margin scheme would in substance provide her with a notional input tax credit for the purchase of the established house. If Kelly could use the margin scheme, then the GST payable on the sale of the townhouses would be substantially reduced. She could also still claim input tax credits on costs incurred in building the townhouses. The margin scheme operates through applying a formula that in effect only applies GST on the profit margin made on the property. To use the margin scheme, certain conditions have to be fulfilled. Firstly, the enterprise must have made a taxable supply of real property, such as selling new residential premises. Secondly, the buyer and seller must agree in writing that the margin scheme is to apply. Thirdly, the supplier must not be an excluded supply, such as if the original purchase was not of an established house, but rather of vacant land that had GST in its price. In the margin scheme, GST is calculated as 1/11 of the difference between the consideration received and consideration for the acquisition. Generally, consideration received for the margin scheme is the same as how consideration is usually calculated for GST purposes. That is, the sales price is inclusive of GST. However, in applying the margin scheme, the calculation of the consideration for acquisition will depend on the circumstances. There are 4 main ways of valuing the consideration for the acquisition of the property. These will depend on when the property was acquired and, if prior to 1 July 2000, when the taxpayer registered for GST. Murray owns and operates a clothes shop. He is registered for GST and enters into a contract to sell the business for $600,000. If the business is sold as a going concern, then it will be GST free and Murray will not have to pay GST. He would receive $600,000 from the buyer and the buyer cannot claim any input tax credits. On the other hand, if it was not GST free, then Murray would likely raise the price to $660,000. This would mean that he would pay $60,000 in GST and still end up with $600,000 in net terms. The buyer, if registered for GST, could claim an input tax credit for $60,000 and end up paying $600,000 in net terms. The advantages to the going concern exemption include administrative simplicity and saving money on stamp duty, as the sales price is a smaller amount. To benefit from the going concern exemption, a few conditions must be fulfilled. Firstly, the transaction must be for consideration, and secondly, the purchaser must be registered or required to be registered for GST. Next, both parties must agree in writing that the supply is a going concern. If the sale involves more than one contract, such as one contract being for the business premises and another for the goodwill, then the agreement to treat the transaction as a going concern should refer to all of the relevant agreements. The condition that the transferor supply all things necessary for the purchaser to continue the enterprise means that no essential supply can be left out of the transaction. For example, a transfer of a home-based business does not fulfill this requirement, as the home-based premises were not transferred as part of this transaction. Some things cannot be transferred, such as personal goodwill, meaning that failure to transfer them would not prevent this condition from being fulfilled. Finally, the condition that the supplier carries on the enterprise until the day of supply means that the business must be active and operating at the time of the supply. The vendor must be able to provide evidence of this. To recap, the real property margin scheme and the going concern exemption can be utilised to reduce the amount of GST payable. However, certain conditions have to be met, including agreement by both parties in writing.